Therefore, I'd like to welcome everyone to this multi-location hybrid meeting with the Pensions Committee, and to welcome everybody who's made it into the Civic Centre this morning. It's lovely to see you. And equally to welcome everyone who couldn't make it and is beaming down at us from the large screen to my left. This meeting is open to both the press and public on request. Currently, there is nobody in the public gallery, and we haven't had any requests for the substantive body of the meeting.
It was a request, Chair, but they didn't log in.
Fine, okay. So in which case, there has been a request, which you actually just told me, didn't you? Yeah. There has been a request. Somebody's asked for the link, but they haven't logged in yet. And this person's asked before and then hasn't logged in. So maybe they're just playing chicken. So this meeting is not being broadcast live. The recording will be made available later on YouTube, so we can all go back and watch. As ever, we welcome the use of the Welsh language in meetings, but we've had no requests from anyone to speak Welsh today, so the meeting will be conducted in English only. Can all members attending via Teams please refrain from using the chat function, as nobody will be monitoring the chat, and if you want to speak, could you please raise your hand via the yellow hand function when you want to. Also, please remember to keep your microphone muted when you're not talking. Can always lead to embarrassment. In that case, moving on to the agenda, item number 1, attendance and apologies. Garrett.
Thank you, Chair. I've got apologies from Councillor Simons, and I know Councillor Haller attended the training just prior to this meeting, but I don't think he's logged in yet, so just a heads up that he may log in soon.
Okay, thank you very much. Before we carry on, we might go around the table, actually, because I think not everybody will know each other on the table, and then we'll move on to screen. So maybe if we start going around the table clockwise with Betty.
Anthea Wellington, Pension Board.
Ian Coleman, Independent Chair of the Pension Board.
Douglas Green, actually at Hymans Robertson.
Alex Ball, Head of Pensions.
Nathan Yole, Chair of the Committee.
Jill Griffiths, Pensions Manager.
Nigel O'Reilly, Assistant Chief Executive.
Councillor Carl Gordon, Member of the Committee.
Geraint Thomas from Democratic Services.
Lewis Gray, Graduate Pensions Officer.
And there was a reason I started with Betty, because I wanted to welcome Lewis to his first committee meeting. As he said, he's taken... when did you start? Last month?
Yes.
Right, so this is the second month, he's still come back, so I just wanted to make sure, we'll say welcome, good luck, and so everyone knew who you were. Then moving on to the screen, we have... I think I'll just read out the people on the screen. It might be easier than trying to choreograph who's there. So we've got Councillor David Williams, who's a member of the scheme. We've got Councillor Alan Slade, who's a member of the scheme. We've got Ethan Devitt, who's one of our pensions advisors. Then we have Lisa Pearce, John Wright, Susan Davis, Niall Flack, Ian Rees, and Polly Ellis. Like we said, we might have Councillor Haller rejoining, and I might drop him a line. I might text him now, see if he's coming back. So, sorry for going off script. Item number 2, again, Geraint's declarations of interest.
Thank you, Chair. If I can start with Councillor Gordon, I got that yourself and your wife are contributors.
Correct.
Thank you. Just checking, I don't think Councillor Hall has joined us yet.
He hasn't got the link. Can somebody send him the link? I'm on the technology.
Okay, sort that out. I've got apologies from Councillor Simons. Councillor Slade, I've got that you're in receipt of a pension and you're also a contributor. Yeah, just to let you know, Councillor Slade, you're not on mute, but we can't hear you. But I saw that was correct.
Yeah.
Oh, there we are. Thanks. Councillor Williams, I've got that yourself and your wife are in receipt of a pension and that you are a contributor?
Yes, we're both contributors.
You're both contributors?
Yeah.
Right, okay, I'll add your wife onto that, thank you. And yourself, Chair, I've got your father and 2 family members are in receipt of a pension and that you are a contributor. Thank you very much. That's everybody. If Councillor Haller comes in, I will then just have to just double check with him as well. Thanks.
Thank you, Geraint. Moving on then, item number 4, we've got the draft minutes of the Pension Board meeting on the 27th of... I missed item 3. Sorry, agenda item 3, we've got the minutes of the Pension Committee from the 13th of June 2022. This is for members to raise any issues from the meeting and then for us to agree the minutes. So, members, any questions or any matters arising off the minutes? No? Alan? No? Carl? In which case, everyone happy to agree the minutes? Excellent. Those minutes are agreed. Item number 4, in its proper place. This is for information only. These are the draft minutes of the Pension Board meeting, the 27th of July. So these are for noting only, unless, I guess, Ian, there's anything you want to point out?
No, thank you.
Okay, perfect. Item number 5, then, I'll hand over to Alex. This is the Pension Fund draft annual report and accounts for 2021 and 2022.
Thanks, Chair. So members may recall from the meeting that we had in June, where we invited along Audit Wales as the external auditors to the fund, just to give an overview really of the process of reviewing and considering the annual accounts. Just moving things on, and I'll touch on the audit in a second. This item, the substance of the update, is to give members oversight really of the draft annual report and accounts, and this relates to the period to the 31st of March 2022. Essentially, just to reiterate really from the training delivered, the pension fund is required to prepare a separate set of accounts to that of the council. They are obviously then subject to a separate audit arrangement as well. The document in Appendix 1 is essentially the full and quite exhaustive document. I'm sure you will agree if looking through the papers. This is largely driven by accounting standards and guidance that we follow from SIPFA. And within that is sort of essentially an overview of everything that the fund is involved in carrying out during the period, of which the accounts form part of that document. In terms of the process, before we touch a little bit on that detail, as I said, the audit is currently ongoing. It's been slightly delayed this year, which largely follows the timelines of last year, to be honest. And what that means is that there's a meeting in the diary on I think it's the 21st of November for the Pensions Committee to consider what will then be the final annual report and accounts, alongside the finalised audit report, the ISA 260. And in between now and then, along with finalising the audit, as officers, the Pension Board, in their role of oversight, will have sight of that audit report later this month. We hope that the audit will conclude over the next couple of weeks. I think in terms of the appendix, clearly I'm not planning to go through the detail of that this morning, given the amount of context there, but I am happy to take any questions if members have got anything specifically. I think there were probably a couple of high-level points to make, really, that the report demonstrates that we once again have seen an increase in the overall level of membership of the scheme in the year to the 31st of March. That's across, broadly speaking, the actives, deferred and pensioners. The sort of proportion of that membership is increasing in line with what we've seen previously. On the financial performance, a lot of what we discuss around investment returns, for example, and the WPP activity is covered elsewhere on the agenda, and members get a quarterly update on those areas. So I won't dwell here, but I think probably a couple of points to highlight. The fund does remain net cash flow positive, which I think is pleasing, and it is not what can always be said for all LGPS schemes. What I mean by that is that we have enough cash essentially coming into the fund from our employer contribution and our employee contributions that cover off the monthly pension of payroll. And as Douglas alluded to in the training earlier today, and what will follow in the agenda later on this morning, that's quite a critical consideration when planning for future contribution rates, and the need, obviously, for what we specifically need from our investment returns. We added about 218 million to the value of our overall assets during the year, which again I think is positive. It shows that the fund is doing what it can to improve the overall performance and funding of the scheme, whilst minimising as far as we possibly can the level of contributions that our employers are asked to pay. And within the asset mix, the portfolio hasn't changed significantly during the year, although as we've already talked about in prior meetings and we'll touch on later today, there are plans to sort of adjust our strategic asset allocation adjust our actual allocation in line with the strategic allocation that was agreed by the committee a couple of years ago. There is a detailed section on asset pooling. The WPP, it's clearly an important area that's growing within the fund's governance and within the oversight of the investments. Again, if there's any questions on any of that, I'm happy to take them. There is also a detailed section on the admin performance of the scheme and much more on the details there, which Joe usually covers as part of a quarterly update. And again, we're happy to take any questions. But I think for now, really, the purpose of this item is just to give you that oversight that this work is ongoing. And we hope to have, we will have a finalised version for you to consider in November that the board would have also had the opportunity to look over and comment on in the meantime.
Okay, well, thanks, Alex and Joe and the rest of the team for actually putting the paper together. There's an awful lot of information in there, so again, we're not proposing to go through it line by line. As Alex has already said, there's a special meeting in everyone's diaries on the 21st of November, isn't it? Yeah. To sign this off. But this is an opportunity, if anybody has any burning questions or any points they want to raise off the reading of the draft report, we can maybe go through them. Anybody at home? David, no? Carl? No. I've raised my issues privately with Alex, so I don't. I've got nothing to raise publicly. In that case, then, thank you very much, Alex, for item number 5. Moving on, then, item number 6. So this is the Wales Pension Partnership update, which is again from Alex. I think there's been quite a few developments since the last meeting, as we've had discussions at WPP level about the establishment of the active sustainable sub-fund. So, Alex, back over to you.
Thanks, Chair. Again, another quarterly update really for members' information. Hopefully you're familiar with the format of this from the last time we met. Clearly, I think the points to make here is that the last WPP formal meeting, that's the Joint Governance Committee, of which the Chair represents the views of the Greater Gwent Fund, that took place in July. There was one scheduled for a couple of weeks ago, which was sort of cancelled, actually, in light of the passing of the Queen. And so the next meeting will now be in December. Within this update, there's a couple of areas to address, really. I think the minutes from the 8th of July meeting are available for members' information, really. And I think the key points from that agenda I've raised elsewhere here, and I will touch on in a second. The operator update, so hopefully members will recall Link Fund Solutions are the operator, so they deal with kind of the FCA requirements and sort of provide the infrastructure to the partnership, if you like. Within page 142 of your papers, there's a sort of snapshot, really, of the value of the half a dozen sub-funds in which the Greater Gwent Fund are actively invested in through the pool. Clearly, with market volatility that we've seen, and I'm sure you've picked up within the news, that the valuations there are likely to have fluctuated somewhat over the last couple of months. There's an item on performance, so we won't talk too much about that at this stage, but just want to note there. And I think from the JGC minutes, actually, the pertinent point that the Chair alluded to at the start of this item was around the Active Sustainable Equity Fund. This is a new equity sub-fund that has been launched or is in the process of being launched by the WPP. Russell Investments will again be the investment manager of that portfolio, with a number of underlying managers that are considered to be specialists and sort of thought leaders in this space. Just as a bit of a reminder, really, that this has been an investment sub-fund that's been looked at and considered for probably 12 months or more. It was born out of the appetite of not only officers but of the JGC previously to look at some more sort of focused sustainable investments, as opposed to just the sort of amendments and the work that we've done with some of our existing sub-funds. And essentially, at the meeting in July, this sub-fund, the framework and the principle of it was supported and approved by the JGC. And so the various advisors are now in the process of setting that fund up on a legal basis through Link as well, and we're sort of targeting a launch date of around January 2023. And so we've had conversations with our own local advisors around this opportunity, and I've sort of discussed with the chair as well, and we feel, I should also actually add that we discussed it with the Responsible Investor Working Group back in August, and I think all parties agree this is a good opportunity for the fund to consider in line with its own policy and objectives. And so what the plan in terms of a timeline going forward is that we'll arrange some training for members to have some oversight of what this entails, with a planned recommendation to make an investment to follow in December. So we'll spend some more time between now and then focusing on what this really means for the fund, and to ensure that members are comfortable with the proposal before making a decision on that. Again, I'm happy to take some questions on that, particularly if members have them. Perhaps I'll just pause there actually before I finalise the update.
Yes, thank you, Alex. Now, obviously, for all the members who are at the training online, the WPP training online, was it last week, the week before? This actually made the bulk of that training. So we are obviously all fantastically up to speed and au fait on everything in the fund. So presumably, Alex, it's a version of that training we will receive again specifically for the committee and for the board.
Yes, that's correct. Yeah.
Fine. Okay. Well, just to reiterate to everyone that at that JGC meeting in July, I think at a high level, I expressed our happiness with the work that the WPP has done, and essentially, barring any disasters, that we will be recommending to go forward with the scheme in the December meeting. But essentially, this is where we need to be, I think, and hopefully the new fund can act as a bit of a trailblazer to be shifting some of the other sub-funds that we hold via the WPP into the correct direction in the years to come. So I see that David, Councillor Williams, has his hand up, so I'll take David and then I'll take anybody after that.
Thank you, Chair. You know, to be fair, I was actually looking to test that this was working okay, but just to say that it was helpful to see the direction of travel and the consensus around the direction of travel at that training from other members of the WPPP.
Excellent. Anybody else online? Alan, any question? No? Carl? In which case, thanks very much, Alex, to finish off.
Thank you very much. So I think probably the final point just to touch on is the operator update, which was the second appendix in the papers, starting on page 153. Again, appreciate that there's already a quarterly time lag on these updates, and given the delay in the meeting and where we are now, the March figures are really sort of not that relevant at this stage, but I think it's just a snapshot on pages 154 and 155 of all of the sub-funds that are offered through the WPP. As I say, we've got exposure to 6 of those. So, and you can see on the pie chart that level of exposure relative to our peer funds across Wales. Again, there's some more information in there just purely for your benefits. I think probably the point I just wanted to touch on, given that there have been some updates and some developments, is on page 160. You may recall from the last meeting, I talked about Link Fund Solutions as the operator have been subject for some time to possible buyout or takeover from another organisation. Dye & Durham, who are a Canadian cloud-based provider, have been subject to that takeover for some time, and that had progressed to a stage where shareholders had agreed that takeover. Link Fund Solutions have had a couple of issues circulating them in recent months and years surrounding sort of other things that happen as part of their business, which have not fully resolved themselves and are sort of starting to come to fruition again in terms of developments. And I think one that's recently in sort of September time is a possible issue with the FCA, which has ultimately resulted in Dye & Durham removing themselves from making that takeover. What does that mean for the fund and for the WPP? In short, not a lot at this stage. I think clearly the takeover would have been a bit of an uncertainty for the WPP in terms of what the new buyer of the Link Fund Solutions, which is the group that we contract with, in terms of what the future would have held for them. There are, as I say, the issues circulating Link are well known and well documented within the pool, within senior officers, within the advisors, and with the JGC members. We continue to keep a close eye on that, and in terms of the development of the pool, the actual contract with Link expires at the end of December next year, and so we're currently going through a period of essentially market testing and looking at what opportunities are out there, because we will have to follow a procurement process, which means we will have to re-advertise for this contract. So some of the concerns surrounding Link at the moment could potentially go away as a result of the future of that. But I would just reiterate that we are comfortable with the service we continue to receive from Link, and as officers, as I say, the issues are well documented, and we believe we've got good oversight of the current position. So I just wanted to reassure members that in terms of the day-to-day service we provide, that this has not been affected by the recent news. But given that it's in the news, I just wanted to make that clear. I think, Chair, unless there's any final comments on that, that's the fullness of the update on the WPP.
Okay, thanks, Alex. Do any members have any queries or questions off that second section of Alex's report? No? Okay, excellent. Moving on. Item number 7. So this is 7, isn't it? I'm not jumping ahead again.
No, that's fine.
Right, so this is the quarterly investment performance report, where I think Alex and I had a chat about this. Now, obviously, as this is this meeting has been delayed a month, we're now in October looking at the investment report from Q2. Now, obviously, we're going to ask Betty and Ethan to give us their thoughts on the report from Q2, but actually looking at how things have changed somewhat seismically in the past fortnight, we also thought it would make sense to us and for their reflections on what has been going on with the market since that very small mini budget, whatever the hell they called it, that the government announced 10 days ago, which obviously they're rowing back on by announcing that they're not going to go forward with the 45% cut. So maybe if we could first go over that Q2, and I don't know which way you want to play it, whether Betty, if you want to go first as you're in the room, then we'll move over onto Ethan, or you're going to introduce it first? Yeah. Okay, well, I'll pass over to Alex. Thanks.
Yeah, thanks, Chair. I think that's exactly as I was planning to approach this. Clearly, we've moved on quite significantly from the end of June. In the interest of the typical way that we approach these meetings, the information to the end of June is in your packs, and I think really we're building on some of those themes that have affected markets from sort of Q1 really, but I think closer to home with the cost of living crisis and some of the specific issues around energy and obviously more recently a change in Prime Minister and mini-budget. There's a lot more volatility that I'm sure you're aware of and potentially concerned with, so we'll seek to try and address some of that and provide some clarity. Just in terms of the June numbers, as you say, the fund was still struggling in terms of it was slightly underperforming the benchmark moderately, it should be said. The fund was down around 257 million in the quarter to June, taking the fund to 3.5 billion. Since that time, we don't have the numbers to the end of September. That will follow in December, but we had indicative numbers to the end of August, which indicated the fund, the performance had improved moderately. So whereas in June we were down year to date around minus 10%, it's now more like minus 6.5%, 6.3%. So the fund had recovered somewhat from the June position, but clearly September has been quite volatile, and so we could perhaps expect to see more of what we've seen earlier in the year. I think it probably is now a good time to turn to Ethan, who's got usually covers in great detail the macro picture. And clearly, Ethan, if you could just sort of reflect on maybe what we're seeing more recently as well as your general update, that'd be helpful for members.
Great, yes. So this report that I wrote was written in September, so a little bit more up to date than obviously the cut-off we had to do for the actual performance. And even though there's been more sort of tumultuous developments since then, many of the themes are still valid. So I'll still build on the themes that I've been discussing in other meetings like this. And obviously there's been a development further with the mini budget, which I'll touch on. And I'll touch a little bit about some turmoil we've seen in the news regarding other pension funds, which thankfully do not affect you or other LGPS funds. But I will just briefly discuss what's been going on there, just so that there's some context in that. So when I last spoke with you, I was, I believe, referring to 3 themes which were most dominant in markets, and I referred to them as 3 I's. They were inflation, rising inflation that was now seeming to be persistent and sticky, as it was not just involving more transitory factors that may have been driven by supply chain constraints. Interest rates, which were obviously the new concerted and synchronized global central bank response to inflation. This is the traditional tool to control inflation by trying to constrain demand and looking at from the demand side. This is something that all central banks, with the notable exception of one in Turkey and also China and Japan, we're going to get on board with in terms of raising rates. And there seems to have been this competition in terms of credibility. Each central bank afraid of losing credibility versus the next, and determined to assert themselves as to how strong and how steadfast they will be in controlling inflation. We've seen the US Federal Reserve come up with 3 consecutive 75 basis point rate hikes, which the first one was the first that had occurred in decades. And that is perhaps ahead of the pack now in terms of where it is moving. We've seen the European Central Bank respond to inflation numbers there that have topped 10% by finally getting out of their rut of negative rates. And we've seen the Bank of England with back-to-back rate rises. Unfortunately, given that inflation is perhaps more severe in England due to the weaker pound, there has been, unfortunately, a sense that the Bank of England has not been fast enough and has maybe been compromised in some way politically by not raising rates. There was some disappointment, not raising rates quickly enough, some disappointment around the recent 50 basis point rate hike. That was right after the everything was stalled around the funeral arrangements, that was not fast enough. And I'll touch on that again with respect to the mini budget. So inflation, interest rates, and then the other eye was the invasion of the Ukraine, and that was clearly dominating the political news. It was also exacerbating some of the energy prices in Europe and energy security issues. And then also clearly just the uncertainty, the level of uncertainty in markets was raised by that. Those 3 I's moved on during the summer to what I was deeming the 3 E's. We moved to look at energy, which is clearly still a dominant factor and driving much of inflation in the UK. Expectations, and that is a very broad category, which may be discussed around interest rates, expectations, government policy response expectations. We've all been assessed of what to expect when we're expecting, to use that expression. And then the final E is the elections. We have the US midterm elections approaching, and we've also clearly elections are at the back of everyone's mind when it comes to any policy action that we're seeing here. One of the themes I brought out in the book, it wasn't a book, in the report was is this a bull or a bear market? I think that has now been answered for us. There was a question as to whether this was a bear market rally we were experiencing in July with some strength in markets, or whether it was the beginning of something more durable. I think now that we've seen markets retreating entirely, we can see that it was perhaps a bear market rally that we saw. We have seen markets retreat from what they had gained in the summer. There have been 3 consecutive quarters of negative performance in equities and bonds. This is in the US. The UK has been slightly better in terms of the FTSE performance, but now we're again negative for the year. So clearly market sentiment has got extremely negative on a global basis. Let's discuss the areas outside the UK very briefly, and then we'll move to the UK. The reason the negative outside the UK is there has been a sense that inflation is not yet started to recede. It's still rising, which is interesting given that some things, commodity prices, have actually come back to the prices that they were at before the Ukraine invasion. So we've seen some food commodities come back. We've seen shipping prices come back. We've seen oil prices come back, not natural gas notably, but many of those prices are actually back to base levels. So therefore suggesting that this has been a momentary blip in the supplies, and that should factor through, but there is a lagging indicator. So that, as well as the Fed being steadfast and other central banks on seeking to continue raising rates, has really led to a lot of negative sentiment, and equity markets have been negative. As far as then what's been occurring in the UK, well, clearly already, even prior to the mini budget, there was considerable weakness around the inflation numbers, the sense that this was now the weaker pound, the government, which was essentially, it's been described as driving with one foot on the brake and one foot on the accelerator. The foot on the brake will be the Bank of England trying to control demand through interest rate rises. and then a new Conservative government which was seeking to stimulate growth through essentially the fiscal punch bowl. So just where central banks are taking the monetary punch bowl away, we've now seen the fiscal punch bowl being offered up in exchange. I would say today's announcement where they said, we get it, we have listened, regarding the 45 basis point tax rate, that's probably going to send some positive ripples through markets. As part of the problem with this mini budget was the abject lack of communication that went on regarding some of it. And that, of course, caused considerable uncertainty, a sense of a cleavage perhaps between the central bank and the government, and that sense that, you know, driving with one foot on the brake, one on the accelerator is clearly no way to run a recovery, run a country, and that was completely undermining confidence. In terms of, and Betty, I know we'll talk about what this means for your portfolio, I will say that, as always, we've said that having a global portfolio is positive when there's a weakening of the currency. There is essentially a form of a windfall coming into effect, and that is something that you will enjoy in the portfolio. The FTSE, you have exposure to UK equities, because that is an outward-looking, export-driven equity market that is then tending to behave positively. So we've seen that it's still negative for the year. It's more negative than when this report was written, but it's still quite positive relative to other equity markets for that reason. Fixed income has been negative because of the sharp rises in rates. So we've seen bonds and equities, as I mentioned, moving in sync, which has been an unusual circumstance, no hedge provided there. And the private asset side, which you're only beginning to dip your toe in the water regarding, obviously there has not been that same kind of mark-to-market effect there. Just wanted to briefly touch on the developments in UK markets since the mini-budget. So clearly there was a stark reaction to the mini-budget accompanied by a sell-off in UK gilts and jumps in those yields that have been unprecedented, particularly at the long end. Part of this is due to the low liquidity in UK gilt markets, and this then has been exacerbated post-Brexit. Not as many natural buyers of these gilts. Many of the buyers of the gilts are UK pension schemes, in particular defined benefit schemes, which are hedging their liabilities. I do have one client in that category, and I'll say that this has been a calamitous period for clients of that, for clients in that situation, because there has been essentially a kind of a vicious feedback loop regarding they own gilts, they have to reduce leverage, they know they have to sell gilts, everybody else knows they have to sell gilts, and this has been further then driving pricing down and driving yields up at the long end of the yield curve. And then because these yields have been jumping, we've seen a further spiral of forced selling, which was, of course, the catastrophe that forced the bank to intervene at the middle of last week to support that market by saying they would buy up to £5 billion in gilts. They only actually had to buy about £1 billion, so that's a sign perhaps that it wasn't quite as severe a crisis as it seemed. But there was still considerable pressure on these pension plans, and most of that has been driven by the old, as Betty will know, anyone who's been in these markets for many years, leverage and illiquidity do tend to be the single most toxic combinations for any entity trying to exit an investment. So this is not something that our fund has. We do not have leverage, nor do we have any concentration. So we were sitting at the sidelines from some of this crisis that affected other pension funds. But I'm happy to answer any questions on that, because clearly it has attracted a lot of headlines in the news recently. So here we sit with a slightly modified budget and still very uncertain outlook for the year ahead. That's what we're going to be focusing on from a portfolio standpoint, how robust the holdings are, how robust our asset managers are. Everybody has been in some way buffeted by this considerable volatility in markets, and we want to see that there is some form of resilience there. We'll be focusing on that. Equity markets still have a long winter, you could say, of uncertainty ahead. The energy price rises are going to be exacerbated in the winter. Demand picture will be exacerbated, and we need to know now how many of these economies will navigate the uncertain months ahead. Geopolitically, things are heating up as well. We've seen much more rhetoric coming out of Russia, Ukraine, And we also have elections pending in the US, which could in fact lead to even more uncertainty there. That has been the engine of global growth. If that engine now starts to sputter, who knows where market sentiment will go. The final point I want to touch on, I won't go into in detail, but it is in the notes, is that kind of focus the spotlight on the energy trilemma that I put down there. This may come up later when we speak about responsible investing. Just to say that I think it's nice to explore just what are the policy challenges that governments are now forced to juggle. Energy security, energy prices, and then the question of energy sustainability has not gone away. We can see that at sometimes one of these concerns dominates, and right now it's security and pricing, it's not sustainability. But these three legs of the stool need to be monitored to ensure they're all being supported. So when we speak about, look at the challenges and some of the output coming from government, and when we look at our own responsible investing policy, it will be important just to look at these three factors, because no one can be sacrificed at this juncture. But I do think it bodes well for renewable energy sources, and that's something that's in your portfolio and that we're continuing to develop and emphasize. So I will leave it there. There's been a lot of information thrown at you. Happy to take any questions or wait till the end of the discussion.
Thanks, Ethan. Any questions before we move? Perhaps I invite Betty in to just comment a little bit more in terms of what the fund is thinking.
Yeah, thanks, Alex. Yes, very comprehensive covering of what's just happened by Ethan. I would also just mention one additional thing, which maybe because she's sitting in the US and I'm sitting here, despite our mix of accents. You know, one sort of peculiarity to UK investors like Torvine is the impact of the pound. And, you know, your liabilities, of course, are all in sterling. But, and the reason I mention this is it's another thing, just like what Ethan has discussed with, you know, the gilt yields and the inflation-linked market. It has fallen through June, which you have numbers in your pack. The pound versus dollar had fallen by about 10%. Through September, it has now fallen by about 17%. I mean, it is unbelievable. And, you know, usually we're used to, you know, a couple of percent here or there, and then there are all these people who, well, you know, it's up one week and up down the next week and stuff like that. It all comes out in the wash. It's not coming out in the wash. This seems to be a much more sort of sustained downward trend. Now, this has pluses and minuses for you, as Ethan alluded to. In part of our portfolio is actually in non-sterling investments like these global growth funds, the low carbon BlackRock fund and the WPP global fund. However, there are some funds, whether they have global investments like your fixed income, government and credit, they actually hedge back to sterling. Or Lewis had prodded me to do a bit more work on one of your multi-asset funds, and we've actually, if you unbundled the returns, you found that actual swapping back into sterling to avoid sterling volatility has become a huge cost in some of these strategies. So I would think it is weighing on some of your returns, particularly in bonds and in some of the multi-asset, and maybe woven through some of the others where it's a little less hard to break out, but we can. So I just wanted to say that while the returns in through June of minus almost 6, and through August we've seen is about minus 0.4. You know, given what's going on, are really quite good. 3 funds that I know have swaps back to sterling that cost a lot, count for about nearly half of that minus return. So it is a material fact, and just needs to be borne in awareness. Now, of course, if sterling recovers, the opposite will happen. The funds that have an exposure to non-sterling, mostly dollar, will suffer versus sterling, and the ones which have a hedge to sterling, that will be an asset. This does play again into your asset liability, your funding ratio, because all of your liabilities are in sterling. You know, I do think personally that we need to at least think about some ways to lock in and manage this very fundamental and big currency risk, which is at the heart of our portfolio. And I think with these dramatic moves, it's caused us to look at this the way we haven't before. And sterling's weakness is directly tied to, it's not causal, but it's highly correlated to rising inflation because of the amount of energy and things that we import. So, while we bemoan the cost of inflation in our pension, to what we pay out to pensioners and the future liabilities, the fact that we're paying them out in a cheap currency is a positive offset. So there might be ways to retain a little bit of that benefit and not give it all back. Nobody has a crystal ball. But anyway, I just wanted to say, from a UK investor standpoint, there's this other factor, which is, also swinging your returns around in different ways that people outside the UK don't necessarily focus so much on. But that can also factor in why there's been less global demand for sterling bonds, because, if you think this is a weak currency possibly going weaker, people would rather have the dollar where you also have high returns.
Yeah, thanks, Betty. And I think perhaps one thing just to sort of put members' radar really is that part of the fallout of the actuarial process that Douglas talked about in the training this morning, that we covered it on the agenda, that can also and should also really trigger a review of our investment strategy to make sure that the two are aligned. And obviously, Betty's alluded to the foreign exchange potential opportunity there, but obviously to be mindful of given our current strategic asset allocation, and that's something that we're thinking about at the moment in terms of what we may bring forward to the committee in future around a revised strategy. I think just to provide maybe some more assurance, really, we continue to meet all of our managers on a quarterly basis. Clearly, they are very challenged by the market backdrop at the moment, and a lot of them cite some of those significant issues as factors in their ability to deliver on the performance. What I always try to do is to remind members and officers, colleagues, that we are a long-term investor, and we're obviously very conscious of the current market environment. But on page 168 of your papers, there's a graph in there which essentially is an extract from our performance report. And if you look at the longer-term time frame, so 3 years, 5 years, 10 years, and the inception to date, you'll see that our performance is still in positive territory, which is really pleasing. It's critically ahead of the long-term actuarial assumption which was agreed at the 2019 valuation. Clearly, that's to be looked at again for the 2022. And also the fund is ahead of the index, which is the benchmark return. So it's showing that added value of active management, which is another core component of our consideration. So there's perhaps not much more to say. Obviously, questions welcomed if there are any. It is a challenging period. We don't have the extent of the September numbers to really quantify the impact of the last couple of weeks particularly. But as I said, through August, it was an improved position relative to June, which is what is the nature of the update today. And we'll provide another detailed update in December, which will reflect on 30th September figures, and obviously that what goes ahead in the next couple of months.
Okay, thank you, Alex, and thank you, Betty and Ethan. Very comprehensive. So I might break that down. If there are any questions initially on the report up to the end of quarter two, Alan's shaking his head. Carl? David and John? No? Yes? No? No? Fine? Okay. If anybody has any questions about actually how, and this is, we're moving into speculation actually, about questions about the more recent market volatility, I have a question, which I'll probably get told off by Alex for asking. But is there any, thinking back to what has been the main subject of conversation since the new committee was formed, which is more about how we move towards a more sustainable portfolio in terms of our interactions with the market, if there continues to be a downward trend in terms of the strength of sterling and the issues that Betty just talked about potentially getting into a spiral, about a weaker currency and weaker returns on some of those investments, is that going to start throwing up problems for us as we move towards a more sustainable portfolio, in as much as actually at what point does the tension erupt about the need to be making an investment that actually secures a return versus making potentially lower returns but more in more sustainable markets, or are we many a month off that dilemma yet?
Well, thanks. That's a great question, and I think just to sort of take take on from what Alex has said about being longer-term investors. I mean, I think the weakness of sterling, the global rise in oil prices is got to be accelerating the shift to renewables, which is a good thing. Even just on my train ride today, I was surprised at how many more houses have solar panels than last time I came out on the train. I mean, now this is anecdotal, but it does tell you something that, you know, when people start worrying about their heating bills, they say, well, actually, you know, I'm going to put those solar panels on and, you know, and shield myself. It's an economic response that people don't necessarily make when energy is really quite cheap. So this is, you know, another a high price is another thing like a carbon tax, which shifts behavior, which is what we really need. And I think it will, you know, there'll be, you know, just huge demand that we need to meet through new infrastructure and new investments, and there will be opportunities that I think we should be aware of, and, you know, making sure we get a return which makes sense versus what we need to earn actuarially and risks involved and things like that. But I would see an acceleration of opportunities. Thank you very much, high energy price.
Ethan, anything like, yeah, your hand up.
Yeah, I just raised my hand I know there's another hand raised, but just to finish on that point, I think you do make an excellent point about the returns. Clearly, any time our funding level is going to be impacted, and it will come down as our asset level has fallen, there is a need then, therefore, for our asset base to work harder in order to deliver that. The good news is that we've always targeted a return which is in excess of the return, the required return that we would need to get to full funding. And if anything, that return potential is arguably higher now, and that we do have higher interest rates. We can intrinsically get more from our fixed income portfolio. As an example, broad fixed income is trading at much higher spreads today than it would have been. It's actually, you can make money with money in the bank today, that was not possible before. Now, of course, we always have to look at what that return looks like after inflation. That's the most meaningful number. So clearly we have to work even harder. But equally, equity markets having dipped close to 24% in the case of the US, it's only 8% in the case of the UK. Clearly, they're now at lower levels. So you could say that the return potential from here should be higher, although there will likely be greater volatility in the immediate future. As far as you know, what this means for our sustainability agenda, I say it's important that we've never contemplated sacrificing return as part of that. So it's not like we're accepting a lower return path because we want to be getting to net zero at a certain point. That is not something that we believe is a trade-off that is necessary today. And as Betty touched on, there's actually been, yes, the higher energy prices are causing changes of behavior. And we think that factors better in for renewable energy. But it also has led to a windfall for some of these renewable energy companies because energy prices get set at the price that the market clears, and that is now considerably higher. So even if there's a price cap for consumers, that's still not affecting the wholesale price for the most part. So there will be at least the price that the manufacturers are enjoying. So that's actually many of these renewable energy firms are enjoying a windfall for now. It may be taxed elsewhere in Europe, but they're plowing that back into the business, making more investment in the business. Those are all areas we have exposure to.
That told me. Okay, thanks, Ethan. David, you had your hand up. Presumably, did Ethan answer that question?
I think so. I was really going to comment that I thought it was very helpful going through the trilemma and the impacts of the one thing to the other, and obviously the intervention from Betty explaining, which again sort of kind of confirm what thinking was, which is actually that, you know, circumstances have a positive outcome in terms of some of the behaviour change and make some things more economically viable and seen as reasonable, I suppose. But I think it's very useful and important for us to keep in mind that trilemma and the balance around energy security and sustainability.
Thanks so much. Alan, any questions, any comments on the report tonight? Can't remember. John? No? Okay. Unless Alex has anything we failed to raise that you wanted us to, we'll move on. Thank you very much both for your reports. Right, item number 8.
Sorry, Jay, before we move on, can I just ask Councillor Horler to confirm his declarations as he wasn't here at that part of the meeting?
Of course. John?
Councillor Hall?
Yeah,
I've got that you're a contributor to the fund. Is that everything, please?
yeah, that's correct.
Okay,
so,
thank you.
Excellent. Okay, thank you very much. Okay, then item number 8. Then we've got the administration. Can't say it. We have the administration update. Joanne.
Thank you, Chair. So this report just gives an update of the work that's been carried out by the administration team. So there's only a couple of things that I wanted to draw your attention to. So we had a very good year end this year. 55 out of the 57 employers met the year end deadline. And that's particularly important this year as it is the valuation year. So based on this, we managed to submit the data to the actuary by the 7th of July and get emails out to all members informing them that their annual benefit statements are available by the end of August. The annual benefit exercise has increased our membership on My Pensions Online because we've been asking everyone to log in to access their statements via My Pensions Online. So looking at the data today, we have just under 22.5% of members signed up to My Pensions Online. And considering we only went live with the system last year, I think that's pretty good. So we'll just build on that year on year. The other development that we're working on at the moment is iConnect, the data submission between our employers. So now we have 46 out of 57 employers submitting data via iConnect. So that's going well, and we're hoping by March next year to have all our employers on using iConnect. And then finally, I just wanted to mention the pension dashboard. So the staging date for the public sector pension schemes have been delayed from 30th of April to 30th September 2024 to provide more time for the McLeod remedy to be implemented. So the fund is looking at preparing for this, ensuring that the data that it holds is accurate, and this will be an ongoing work that we'll be carrying out over the next few months.
Okay, thanks, Joanne. I have a question, actually, but before I ask it, does anybody else have a question? Anything you clarify? I haven't put my teeth in this morning. Does anything else need clarifying from Joanne's report? No, I've just got a quick one then on item 7 of that report, when you're coming back to the compliance with the new system, the iConnect system. Is there any other reason other than just the logistics of getting all the information data online? Is there a reason why we are the only authority that is currently on the system?
So County Council have worked closely with us as the fund to get the data ready. The main issue our large employers are finding is basically writing the reports, because you can imagine the data for the local authorities is huge. Yeah. Write the reports to get the data uploaded onto iConnect, but we are working with every local authority to get their data on board. It's just the way things are, yeah.
They haven't quite got there yet.
Yeah, but they're working on it.
All right, fantastic. Yeah. Okay, anything else? In which case, thank you very much, Joanne. Item number 9 is the quarterly risk register update. So that's back over to Alex.
Yeah, thanks, Chair. Another quarterly update. The copy of the risk register is available in the appendix. I think within the covering report on pages 213 and 214, or particularly on 214, it highlights a couple of changes during the period. I should say, in terms of the process, just to remind members, typically how we've been dealing with the risk register is that we take the same item to the board at their meeting, which sort of is intermittent with the committee, and the board tend to focus on some of the risks there as part of their oversight role, and so any changes and discussion points there we tend to reflect into the pensions committee report for your information, and subject to any sort of comments we would make those changes, and the cycle would repeat again. And the board actually meet at the end of October, where we'll be looking at this again. I think perhaps just to touch on that, given that there are some sort of significant updates around the funding strategy and the actuarial side of things that we've talked about already today, a review of a lot of the risks in the register that are linked to that process are underway. And so it's reasonable to assume that by the December meeting there could be some more changes or some updates actually to the thoughts around those sort of risks. With Lewis coming on board as an invaluable resource to me, we're now actually looking at the register more generally. As I realise it's been a few years since we had a sort of a whole overview of it. It's tended to be more of an evolutionary document. So I just wanted to make those points at the start, really. In terms of the document itself, there were a couple of changes this period, or some updated comments which are in red in the appendix. In terms of specific risks, there was a risk on Brexit and a risk on COVID. In fact, there are two risks on Brexit. One has not been picked up as part of this review, but will be in time for the next one. That we felt that, and this was sort of a view shared by the board, if you like, that given that we've now advanced beyond the sort of formal deadline with Brexit, a lot of the processes are sort of being embedded into our day of working. It's also worth saying that a lot of the implications or possible implications of the risks that we'd identified are captured elsewhere on the agenda, on the register anyway. So it's not as if we're not looking at these risks any longer. We just don't feel there's a need to have dedicated focus on them. And I think COVID is another good example of that. Clearly, the way we work now, our processes are much more resilient to any future, let's hope not, but any future sort of issues around COVID that cause us to return to a home working environment, for example. So we felt there was merit in being able to remove those risks altogether. Risk FI11, which I highlighted as an inherent risk scoring increase, that's largely akin to the discussions we've already had around markets and the significance we place on government bonds as a kind of underlying assumption. Again, I mentioned the fact that we're looking at a lot of our funding-related risks as part of this quarterly review, alongside the work that the actuary does for us. So any further changes or any further consideration will be borne out in the next review. I think that's probably all that needs to be said at this stage, but I'm happy to take any comments or any questions on that.
Dropping in it slightly, Ian, as chair of the board, is there anything you'd like to add off the back of the risk register the last time you met?
No, thank you, Chair. We'll review it again in end of October. Thanks.
Excellent. I'm quite happy with what Alex has said. Any members got any questions? Lots of shaking heads online and in the room, so excellent. Okay, fantastic. Cheers, Alex. Back to you, though. Yeah, never any rest. For item 10, which is the update on the Responsible Investor Working Group.
Thanks. This item, to be honest, has been, again, brought for members' information, actually at the request of the Responsible Investor Working Group. So just as a bit of a reminder, this is an informal group, if you like. It has no decision-making responsibility, although it's proven as a very helpful sounding board and sort of steering group in terms of the work that the fund is pursuing, both as officers and members. This group existed with a combination of pension board and pension committee members, and it did pause through the local election cycle during the spring summer. But we reconvened and got it back on the agenda, with the first meeting taking place in August. Just in terms of membership, Councillor Williams and Councillor Yola are both representing the views of the committee. We've also got membership of the board, which is Ian Coleman, who's the chair. We've got Steve Harford and Bob Campbell. So it's a good mix of representation. We also do make provision for, and undoubtedly will utilise the expertise of our advisors from time to time when there's specific items on the agenda that need to be considered, and that could be actuarial advisors, investment advisors, or our colleagues at the WPP, as and when needed. So I think it really at the request of the members of the group just to provide a high-level update for the Pensions Committee benefit in terms of what's being considered. As I said, the meeting took place in August, and we also have one now scheduled for November. Pages 231 and 232 cover at a high level the agenda really from the last meeting. I didn't plan to go through the full extent of the detail, but perhaps a couple of high-level points that the group historically, when it was formed, sort of 2016, 2017, was intended to be to a sort of a task and finish group, if you like, to help establish the fund's responsible investment policy. I think we recognised, or my predecessor recognised, the valuableness of the value of the group's input, And so that's continued, but we just felt with new membership and the fact that the agenda is obviously becoming more and more complex and exhaustive, that the new terms of reference would be helpful. So that was sort of discussed, and there's some recommendations for some updates. We'll take that back to the November group, and once that's agreed, we'll provide a copy for members of the committee just to have some oversight really of what the function of that group really entails. The rest is fairly self-explanatory, hopefully. Training is clearly a focus for all members, but particularly with the IWG sort of exercising that role, they felt it was important that more of that is forthcoming. One area I didn't actually touch on in the quarterly investment report, not that there's a significant update really, but we previously reported on the fund's exposure to Russia, given what we know is going on there. It was relatively minor at the time. Basically, since that time, everything has been written down to zero. So our overall exposure in monetary terms and in percentage terms at the moment is zero. There is the possibility that will increase over time if things change, but clearly we've made an intention as both as a fund and as the WPP that we would look to divest as soon as practically possible from any residual holdings there. So I just wanted to make that point that we did discuss it with the IWG, and it was recommended that we included that update as part of the committee agenda, and it was covered in item 7. I think that was probably it, Chair, in terms of update. A lot of it's there for information purposes, but I'm happy to take any questions if there are any.
Okay, thank you, Alex. Actually, I don't know, David or Ian, are there any comments you'd like to make off the back of that report? David is shaking his head.
No, yes, again, thank you, Chair. No, nothing to add.
I don't have anything to add either. Just to say, actually, I think we all found it quite useful as a space and a forum to start kicking some ideas around. It was quite good to start thinking about that medium-term strategy, and also that being sort of month 3 or 4, it was quite a good forum to realise that things were beginning to make sense. As I must admit, the first month or 2, I was somewhat at sea. But it's not all about me, so we'll move swiftly on to item number 11. So back to Joe for the update on elected member training.
Thank you, Chair. This report is for information. Appendix 1 of the report sets out the training that pensions committee members have attended. And there was just 2 points that I wanted to draw your attention to. So the first one was in relation to our actuary, Hymans Robinson's 2022 National Knowledge Assessment. This has been launched now, and we are inviting pensioners to partake in the assessment. It will help the fund and give us an insight into the knowledge levels of key decision makers, and it will also help us identify our future training needs, which we can then update our training plan. So following the meeting today, I'll send a link to all members of the committee with details of how to log on and complete the knowledge assessment. And then the only other thing I wanted to do was remind you about the LGPS Governance Conference that's being held in Cardiff on the 19th and 20th of January. So I'll send a reminder to you all regarding this as well after the meeting. But if you'd like to attend, then please just let me know.
I can't remember what I've said yes to. Thank you very much, Joanne. Just quick questions. I know I've signed up to the meeting or the training in the LGA in London, which is in November, isn't it, I think. Has everybody else signed up to that, if only hybrid meeting? Because obviously there's been an issue with what was historically the Cardiff-based meeting has been taken off the table. You haven't seen it, okay.
Yeah. I believe that's the fundamentals training. Is that right? The 3 sessions? Yeah. Yeah.
Fine. So nod furiously and I'll move on. Great. Fantastic. Item number 12 then is date of the next meeting, which we've agreed is a special meeting on the 21st of November 2022, and then we're back in the normal cycle of meetings at the 3rd of December? 3rd or 4th? 2nd?
Second week, sorry.
Oh, 2nd week, okay.
12th.
The 12th, okay. So that's dates to note in the diary. Moving on to item 13 then, is the exclusion of press and public. So, to agree the exclusion of the press and public from the meeting as presentations and meeting papers are not for publication, because in accordance with paragraphs 12 and 14 of Part 4 of Schedule 12A of the Local Government Act 1972, as amended by the Access to Information Variation Order Wales 2007, it contains information about a particular individual and information relating to the financial and business affairs of particular persons, including the Council, and in all the circumstances of the case, the public interest in maintaining the exemptions outweighs the public interest in disclosing the information. Thank you very much, Gerard.